You ever notice how everyone online argues about which ETF is better? More tech, less tech, more growth, more value. But almost nobody talks about structure. And there's a lot of noise. S&P 500, total market, international exposure, factor tilts, dividend ETFs, small caps. Most people start with the classic answer. Just buy the S&P 500. Something like Vanguard S&P 500 ETF. And on the surface, that feels simple, clean, safe. But here's what's rarely acknowledged. The main drivers of the S&P 500 are the same mega-cap tech companies that dominate the Nasdaq. People know tech drives returns, they understand volatility, they accept that growth swings harder, yet they still second-guess themselves. Because even though they're holding the S&P, they don't feel balanced. They know tech is carrying performance. They know concentration exists. But they haven't separated the exposure intentionally. The S&P is blended exposure. This is where most confusion starts. So what do? They add a total market fund, like Vanguard Total Stock Market ETF, maybe some international, maybe a dividend ETF, maybe a few individual stocks, thinking they're simplifying, thinking they're diversifying. But often what happens? They create aggressive overlap without realizing it. They own the same mega-cap tech names across multiple funds, just weighted differently, and convince themselves it's safer because there are more tickers in the account. It is diversified. But it can also quietly suppress intentional growth, because instead of designing exposure, they stack funds. They're not managing structure, they're managing comfort. Most portfolios aren't built, they're accumulated, and that's why something feels off. When you pair a concentrated growth engine with another fund driven by the same underlying companies, it looks balanced. But structurally, it isn't clean. It's growth, and diluted growth. That creates overlap. Here's the hidden danger. When you layer multiple funds that all hold the same dominant companies, it looks diversified, but isn't. When those companies drop in price, all of your funds drop together. Your portfolio feels extreme swings, much bigger than expected. That feeling triggers emotional decisions. Panic selling isn't caused by the market. It's caused by structural misunderstanding. Overlap creates cognitive friction. And that friction shows up exactly when you need clarity the most. Now let's simplify this the right way. If tech is the primary growth engine of the modern market, and it clearly has been, then instead of indirectly owning it through the S&P, separate it. Own the growth engine directly through Invesco Nasdaq 100 ETF. Then own the other major sectors, financials, healthcare, industrials, energy, through Vanguard Value ETF. Now you've done something powerful. You've taken what the S&P blends together and made it intentional. Growth engine, stability engine, different drivers, different behavior in different cycles. Instead of pretending the S&P is balanced, you've created actual sector clarity. This is not more diversification. This is more intentional diversification. And here's the structural discipline part most people miss. If you're going to build aggressively, you must build with rules, not emotions, not reactions. Rules, because the way you allocate allows you to be aggressive. The structure you set up is the actual safety. Most people think safety comes from adding more funds. Real safety comes from knowing exactly how your exposures interact and pre-deciding how you'll behave when one side underperforms. Because one side will underperform. Not sometimes, repeatedly. Now here's where portfolio management matters. Let's frame it cleanly. Core base, 80% Q, 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 M, 20% V, T, V. If tech volatility spikes or underperforms for a prolonged period. Shift new money to 70-30 or 60-40. Never sell. Let time plus rebalancing do the rest. That's not market timing. That's adjusting risk exposure gradually. You're not predicting cycles. You're managing flow. And that is structural discipline. You are separating ownership decisions to long-term, contribution decisions to tactical. You never liquidate the engine. You never panic rotate. You don't chase performance. You simply direct new capital with intention. That's controlled aggression. And that's where people misunderstand allocation. They go deep into allocation theory because they want to pick one perfect split and freeze it forever. They think complexity equals safety. They think adding more funds equals control. But often, they're just muting their exposure while carrying similar underlying risk. More funds does not mean more control. It often means less clarity. The real edge isn't picking the perfect static ratio. It's staying fully invested, continuing contributions during drawdowns, letting compounding work. The difference between 80-20 and 70-30 over 30 years? Small. The difference between staying invested and missing 2 years of contributions because volatility shook you? Massive. That gap is where most long-term performance is lost. This structure does something different. It acknowledges tech drives growth. It isolates that exposure. It pairs it with non-tech sectors when they shine, like financials, healthcare, industrials, and energy. These sectors often move differently than tech and can provide stability or upside when tech is underperforming. It avoids unnecessary overlap. It avoids dilution. And it gives you control. New contributions. That control is everything, because actively managing where new capital goes without disrupting your core is the real power. You don't sell, you don't panic, you don't abandon strategy mid-cycle. You simply direct incoming capital with intention. That's not emotional investing. That's structural discipline. Portfolio management isn't about arguing online over S&P versus total market versus international splits. It's about building a structure that protects your psychology, keeps you fully invested, adapts without overreacting, and compounds through every cycle. Because the real alpha is staying invested long enough for compounding to become unstoppable. Structure beats noise. Intentional exposure beats accidental overlap. Discipline beats prediction. And actively managing contribution flow, not constantly hopping funds, is where the real power is. And here's where this becomes practical. This allocation isn't just a theory. It's a structured engine designed to compound. The first place that structure belongs? A Roth. Because if you're going to compound aggressively and systematically, you want that growth shielded. Tax-free growth. Tax-free rebalancing. Tax-free compounding. That should be priority one. Build the structure there. Max it. Protect it. Then once that foundation is full, you replicate the same structured allocation in a separate brokerage account. Same philosophy. Same discipline. Same contribution flow rules. Now you've built two engines. One tax-advantaged, one flexible. Both compounding. Both structured. Both protected from emotional interference. And only after those two foundations are stable. Only after they're consistently funded. That's when you can open a third lane, an active account. This is where smaller portions of capital go. Higher conviction ideas, individual stocks, tactical plays. But here's the rule. That account never compromises the first two. Because the first two are stability. They are your compounding core. You don't dilute them. You don't interrupt them. You don't raid them to fund speculation. They run independently. The active account is expression. The core accounts are structure. Most people mix everything together. Core, speculation, long-term, short-term, all blended. And that's how discipline erodes. Separation protects clarity. Core structure compounds. Satellite ideas experiment. But the engine? The engine always comes first. Because real wealth isn't built on constant action. It's built on structured repetition. And when that repetition happens, inside tax-advantaged space first, then scaled consistently outside of it. You're not just investing. You're building a system. And systems compound. Different roles, different rules. And then there's Bitcoin. There's so much noise around Bitcoin. Not because Bitcoin is inherently chaotic, but because most people position themselves in it without structure. They don't allocate it. They chase it. They don't size it intentionally. They swing at it emotionally. So when it rises, they feel brilliant. When it drops 40%, 60%, 70%, they feel unstable. Not because volatility is surprising, but because their positioning was never structured to survive volatility. Bitcoin exposes emotional investors faster than almost any other asset, not because it's reckless, but because it demands discipline. And that's where clarity matters. Bitcoin doesn't belong in your compounding core. It doesn't replace structure. It sits outside of it. Smaller, intentional, pre-decided, because your first engines are designed to compound steadily. Bitcoin serves a different role. It doesn't generate cash flow. It doesn't represent corporate earnings. It represents engineered scarcity, a fixed 21 million supply, a decentralized monetary network, an asset outside traditional financial systems. No central authority can increase its supply. No board can issue more of it. No policy decision can dilute your ownership percentage. Equities compound through productivity. Bitcoin preserves through scarcity. One grows with the economy. The other exists independent of it. And in a world where fiat currencies expand over time, where supply increases through policy and liquidity cycles, owning a fixed supply asset preserves your share of that network permanently. That's a different form of protection, not stability, not guaranteed appreciation, but protection against dilution. Over long periods, if global money supply expands and Bitcoin supply does not, scarcity becomes economically meaningful. That's where preservation and asymmetry intersect, because Bitcoin is also adoption-driven. Its value is influenced by adoption rates, network growth, institutional participation, global monetary policy, regulatory frameworks, liquidity cycles, technological competition, and market sentiment. If adoption increases, if more capital views it as a legitimate store of value, if institutional access expands, price appreciation can be significant. If adoption slows or regulation tightens, volatility increases. That's why it carries asymmetric potential. Downside is defined by position size. Upside expands with participation, high variance, high volatility, high sensitivity to macro liquidity, which is exactly why it does not belong in your core. This will feel uncomfortable at times. That is the cost of holding a high variance asset with discipline. And if you treat it like a core holding without structural boundaries, it will destabilize your psychology. But if you size it correctly, if you separate it from your compounding engine, if you fund it only after your core is stable, then it becomes what it should be: a monetary hedge, an asymmetric network asset, a scarcity-based preservation layer, and a satellite position, not the foundation. Structure first, conviction second. Expression comes after stability, because wealth is built on repetition and discipline, and preserved through intelligent diversification. When you position Bitcoin inside a structured system instead of emotion, it stops being noise. It becomes intentional. Now let's make this real. Imagine you invest $500 a month. That's $6,000 a year. First priority, your Roth. You max it with your structured allocation, growth engine, stability engine, disciplined contribution flow. Let's say over 25 years, your blended return averages 10%. That's historically in line with long-term US equity returns. After 25 years, you've contributed $150,000. At 10% annual compounding, that grows to roughly $650,000. Tax-free. No timing, no prediction, just structure and consistency. Now let's say after maxing your Roth, you invest another $300 a month into a brokerage account using the same structured allocation. That's $3,600 a year. Over 25 years, another $90,000 contributed. At the same 10%, that grows to around $390,000. Now you have two engines, one tax-free, one flexible. Together, you're around $1,040,000 from $800 a month total. Now let's layer in Bitcoin. You allocate $100 a month. Small, intentional, pre-decided, that's $1,200 a year, $30,000 over 25 years. If Bitcoin compounds at 10% annually over that same 25-year period, just to keep assumptions consistent, $100 per month for 25 years grows to roughly $130,000. Now here's the important part. That 10% is not a guarantee. It's not a promise. It's a speculative long-term average. Bitcoin could compound higher if adoption increases, institutional participation expands, regulatory clarity improves, and global demand for non-sovereign assets strengthens. It could compound lower if participation slows, regulation tightens, technological competition increases, or macro liquidity conditions weaken. Bitcoin's price is influenced by adoption rates, network growth, institutional inflows, global monetary policy, regulatory frameworks, liquidity cycles, and market sentiment. It's a high variance asset, which is exactly why it doesn't belong in your core. But if it simply compounds in line with equities at 10%, it still grows meaningfully because it was sized correctly, separated structurally, never allowed to override the foundation. Now look at the full picture. Approximately $650,000 in your Roth. Approximately $390,000 in your brokerage. Approximately $130,000 in Bitcoin. That's roughly $1.17 million from $900 a month total. No stock picking genius. No perfect timing. No prediction. Just structure. Just hierarchy. Just repetition. Now, once all of that is stable, if you want to open an active investing account, you can. Individual stocks, higher conviction plays, tactical ideas. But that account is fed last because the first two accounts build wealth. Bitcoin, sized correctly and positioned after your core engines, adds diversification, asymmetric potential, and a form of monetary preservation, acting as a structured satellite that provides upside and scarcity protection without destabilizing your compounding base. The third account expresses skill, and that difference matters. This is how systems compound. Structure first, scale second, conviction third. Not emotion, not noise, not constant rotation, just repetition for 25 years, even when it feels wrong. That's how wealth is actually built, because structure compounds longer than emotion ever can.